What portfolio adjustments should you make heading into the new year? To find out, we're talking with Bryant VanCronkhite of Allspring Global Investments. Bryant, welcome.
Thank you.
First of all, Friday, Jobs Day coming up. What are you thinking we'll see?
I think we're seeing evidence the Fed's accomplishing their job. I think ever since the inflation battle started, they always knew inflation was the symptom, but the disease was employment. We had a mismatch in supply of labor and demand for labor, and so their job is essentially to try to slow the economy down to get that back in line. And we're starting to see with the JOLTS data this week that the demand for jobs is fading, and I think we'll continue to see that. And so hopefully the number is not too weak as we move in the right direction, but my fear is that we're going to go to the point where they did the job and then maybe slip past it in the months to follow. So got to keep a close eye on that, but I think we're heading in the right direction in terms of the Fed accomplishing that job of getting the employment level back down.
So what does that portend, do you think, in terms of rate hikes, cuts, holds?
Although I think the Fed is less likely to raise rates from here unless something really happens in a shock format, I think the Fed's going to be slow and disappoint the market in terms of when they will actually begin to adjust rates lower. So my view is that let's be patient as investors. Let's not build portfolios on the back of hoping the Fed pivots, but rather try to pick stocks that have the ability to control their own destiny despite what the Fed may or may not do the next 6 to 12 months.
So I know that consumer staples and healthcare are two of the areas that you've been looking at closely. How does that connect to what you're seeing from the Fed, and how are you feeling about those sectors specifically?
So we're looking for companies that, in both areas, that have relatively stable cash flows through a cycle, but also the ability to control their own destiny by deploying their capital. One of the things that we think about as an investment team is how do we find companies that have balance sheets that can expand over time and be utilized for productive things like acquisitions or organic investments, or even buying back their stock right now at relatively cheap prices, especially within healthcare and consumer staples.
Let's talk about some specific names in those sectors. Who do you like right now?
Right now, one of the names in the staple space is Keurig Dr Pepper. I think most of us know those two names, right? Dr Pepper, the carbonated soft drink side, the cold side. It's been doing wonderfully throughout the entire pandemic. Pricing power in the carbonated soft drinks has been very strong. All three major brands have done their job raising prices to offset costs. Initially on the hot side, the Keurig, the coffee side, they started out well because demand spiked as we all stayed home and drank the coffee out of the machines for a while, but that fell down as people returned to work. At the same time, there's a mismatch. Whereas pricing could move quickly on the carbonated side, it moved very slowly on the coffee side. And as inflation on the cost of goods sold basket went up, pricing didn't move with it and margins contracted. So what we see now is pressure on the stock due to a couple things. One, the lag in pricing power on the coffee side, which is now starting to abate. The drop in volume as people move back to the workforce. And three, the GLP-1 phenomenon. All consumer staples, it seems like, tied to food and snacking and sodas have dropped. The multiples have fallen as people are worried that demand will drop as more people try out, if you will, the GLP-1 weight loss drugs. I think all three of those things are exaggerated right now in the stock price. And it's all, as we work through 2024, we'll not only see all three of those kind of resolve themselves, but you'll also see the benefit of what they're doing with their balance sheet. They made a handful of small tuck-in acquisitions or partnerships that are expanding their product set into the energy drinks, into the better-for-you drinks. And as they do that and layer them into the distribution network, we're going to see a lot of good growth out of that, and they'll get back on their algorithm of growing low double digits on the bottom line.
I want to switch gears to talk about another sector that has been affected, maybe in different ways, on the return to office, which is commercial real estate. How are you feeling about the sector broadly, and are there any names in there right now that you like in particular?
Commercial real estate was one of those buzzwords, right? It was assumed that it was going to fall off a cliff, right? We're going to have massive destruction of value. Loans are going to go bad. No one goes back to the office ever again. But commercial real estate is a very broad category. It's not just the New York metropolis, but it's also the small little areas across every suburb of the United States. And when you look at the grander scale, commercial real estate is doing just fine. It's not a huge issue. Now, the way we're exposing ourselves to that is through CBRE, a brand that a lot of us see hanging in signs on every vacant building across America. They are the leader in that space. And not only are they the leader historically, but they're playing offense, trying to grow so that cycle over cycle, they're even bigger. So what does that look like? Well, they're investing organically in bringing over some of the best agents in the sales and leasing side so that as business comes back and as transaction volumes pick up, they're going to have a greater market share. But along the way, they actually have a very large business around facility maintenance. It's a recurring revenue stream that will be stable through the cycle. And so while we wait for transaction volume to pick back up, We have this recurring cash flow stream that's feeding the growth of the business that's going to allow it to be a much bigger and better business cycle over cycle as we look forward the next 12 to 36 months.
Bryant, thanks so much for your insights.
It's a pleasure. Thanks for having me here.
Thank you for watching. Check out QZ.com for more.